For generations, the idea of downsizing in retirement was pretty straightforward, right? Sell the big family home, buy a smaller one with cash. Simple. But what if that old playbook is actually leaving a ton of money on the table? What if it's limiting your options? Well, today we're going to explore a much smarter, way more strategic way to think about downsizing if you're over 55. So here's our game plan. We'll start with a classic downsizing plan and poke some holes in it. Then we'll introduce you to a really powerful tool called a HECM for purchase. We'll get into exactly how it works, all the amazing benefits, and of course the important fine print you need to know.
All right, let's dive right in with the way things have always been done, the path most people have followed for decades when it's time to find a smaller place.
And it's so true, right? On the surface, it really does feel like a straightforward math problem. The logic seems unshakable. And it's been the go-to advice forever because, honestly, it seems to make perfect sense. Here's that strategy in a nutshell. You sell your current home, you take a big chunk of that cash to buy your new, smaller home outright, no mortgage, and whatever's left over goes straight into your retirement fund. The dream is to live totally mortgage-free with a nice pile of cash for whatever comes next. But, and this is a big but, here's where things get really interesting. That simple math often has some serious hidden flaws that can actually hurt your financial security right when you need it most. So let's break down why this old playbook might not be your best move. This slide just nails the gap between what you hope for and what can actually happen. The dream, of course, is that debt-free retirement with a big financial cushion. But the reality, pouring all your cash into the new house can completely drain your liquid savings. It can create new tax headaches, and worst of all, it strips you of a massive amount of financial flexibility. Let's look a little closer at these traps. When you tie up all your equity in the new house, you're depleting the cash you might need for a health emergency or a great investment opportunity. And that leftover cash you invest, the gains on that are often taxable. And get this, in some states, buying with all cash can even trigger a painful property tax reassessment, wiping out tax advantages you've had for years. Ouch. So this brings us to a modern alternative that completely flips the old script on its head. It's a financial tool that was literally designed for this exact situation, and it lets you take a much more strategic approach to using your home equity in retirement. It's called a Home Equity Conversion Mortgage for Purchase, or HECM for short. Now, you might have heard this called a reverse mortgage, but I want you to think about it this way. It is a tool that lets you, if you're 62 or older, buy your next home without having any required monthly mortgage payments. This isn't about getting out of a jam. It's a proactive, savvy strategy to preserve your wealth. And this right here, this is the core mindset shift. Your home is no longer just a place where your money is sitting locked up in the walls. Instead, it becomes an active, dynamic part of your retirement plan, giving you a kind of flexibility that an all-cash purchase just can't touch. Okay, so let's get into the nuts and bolts. How does this actually work? It might sound complicated, but the way to think about it is surprisingly simple and really, really powerful. So here's the process, broken down into 4 easy steps. 1, you sell your current home. 2, instead of paying 100% cash for the new place, you make a one-time down payment, usually somewhere between 45 and 62% of the price. 3, the rest of it is financed with HCM. And 4, the result, you own your new home, but you have absolutely 0 required monthly mortgage payments for as long as you live there. And the financial impact here is just massive. By not paying all cash, you can keep hundreds of thousands of dollars in liquid assets. That is money that stays in your control, not locked away inside your house. So why does that matter so much? Because that cash you've preserved is now available for everything else life might throw at you. You can invest it, you can cover unexpected medical bills without blinking an eye, or you can help out your kids or grandkids. It's all about having options and control. Now, what's really important to get is that this isn't just a win for the homeowner. This strategy creates this amazing ripple effect of benefits for pretty much everyone involved in the deal, including real estate agents. So for homeowners, the advantages are just crystal clear. You protect your life savings. You get rid of a huge monthly bill. And here's the kicker. You actually increase your purchasing power. Think about that. This might mean you don't have to downsize at all. You could actually upgrade, or you could finally afford to stay in that community you love instead of moving somewhere cheaper. And for all the real estate agents out there, listen up, because this is a total game changer. Since a HECM is a federally insured loan, that dreaded financing contingency pretty much vanishes. That makes your deals way stronger and way less likely to fall through. It lets you offer truly creative solutions and tap into the fastest growing group of buyers out there, the 62-plus crowd. Okay, now, just like any powerful financial tool, this isn't a free-for-all. To give you the whole story, it is absolutely essential to understand the rules, the requirements, and the costs that are involved. So let's start with who's eligible. At least one of the borrowers has to be 62 or older, and the home has to be your main residence. And while you don't have monthly mortgage payments, you are still on the hook for maintaining the home and, of course, for paying your property taxes and homeowner's insurance. And finally, there's mandatory counseling with an FHA-approved counselor just to make sure you understand every little detail. Now, what about the property itself? Not every home qualifies. It generally works for single-family homes, condos that are FHA-approved, and some manufactured homes. But, and this is a big one to remember, co-ops and a lot of non-FHA-approved condos are excluded, so that's a key thing to keep in mind when you're house hunting. Let's talk about the trade-offs, costs versus protections. And yes, it's true, the closing costs are typically higher than a traditional mortgage. They include things like origination fees and mortgage insurance. But on the other side of that coin, you get some serious protections. This is a federally insured loan, you have a 3-day right to cancel after closing, and the whole thing is regulated by the Consumer Financial Protection Bureau. So if we boil this all down to one big idea, it's this. A HECM for purchase is a tool that can literally transform your home equity from this static, locked-up asset into an active, flexible part of your bigger retirement strategy. And this isn't just for homeowners to know. As this quote points out, when the professionals, the agents and advisors take the time to really understand these modern tools, they can provide way better, way more creative solutions that truly serve their clients for the long haul. And that really brings us to the final question I want to leave you with. As you think about your own future or the future of your clients or family, is your home just sitting there being a passive asset? Or could it be a powerful tool, actively working to give you a more secure, more flexible, and more prosperous retirement? Something to think about.